Hi everyone, I'm Zach with the Money Channel, and I think it's best that we dive into it. As an overview, CNBC has reported Jamie Dimon says the banking crisis is not over and will cause repercussions for years to come. Specifically, the longtime JPMorgan Chase CEO has said in his annual letter the current crisis is not yet over, and even when it is behind us, there will be repercussions from it for years to come. JPMorgan's Jamie Dimon says the banking crisis is not over and will cause repercussions for years to come. Gotta perpetuate the fear so he can keep hoovering up all those customers from small and mid-sized banks. Smaller market share for regional banks and credit unions and more deposit dollars than the banks know what to do with are the repercussions. So all this mostly due to rolling bank Dodd-Frank, which former Senator Frank essentially caused to happen by testifying that the requirements were too stringent. He was on the board of directors at Signature Bank at the time. He testified against his own regulation. The bank failed and he was mad at the FDIC as they were in the process of getting funding for liquidity when they took it over. Politicians going to politician. Frank gets way too little credit. He helped cause the crash, co-authored legislation to protect against another crash, and then helped dismantle the legislation he co-authored. Listen, he may well be right. I don't know how anyone else feels, but I really wish Jamie Dimon would shut the hell up already. It's fine, it was written in his annual letter, he's a brilliant banker and I have a lot of respect for some of his decisions, but every conversation I've ever had with Jamie is that the sky is falling. His statements are crafted in the best interest for JP Morgan. He knows his statements can move the market, so he's very calculating. I definitely understand that. He is definitely always sky is falling. To be fair to him, finance is basically just constant risk assessment. All he hears and knows are worst case scenarios. As a former bank executive myself, you are 100% correct. Our careers are all about risk assessment. Best case scenario never gets you fired. It's always worst case scenario, thus we always want worst case. Which sounds like the issue with SVB. If reports are true that they didn't have a CRO for a year, it's not the largest leap of logic to think that their previous chief risk officer saw the risk in rising interest rates and executives didn't like what they were hearing. I'm working either the regulations on SVB now. The chief risk officer left in April 2022 and wasn't replaced until January 2023. I can't speak to the rationale for her leaving, but will say I'm not sure it would have made a difference. The bank grew faster than management ability to manage risk. Regulators were aware of the risk, but surely didn't think management would liquidate an entire bond portfolio at such a loss. Regulators can only do so much. I think we will see some nice improvements to bank regulation. I don't know much about banking, but is there some legit organization that can audition banks and tell how safe they are with money management? It's just crazy to me that the whole financial well-being of the country and world can depend on the decisions that bankers make. I feel like the bank should be way more open about what they do with the money. They are basically relying on government money as a backup. Then the public has a right to know which bank does what. Moody's credit rating is a good place to start. There was until the Republicans under Trump gleefully gutted the regulatory framework. Yeah, the people who the banks pay regulate the banks. They're the same people who give the banks money when they make bad decisions. It's the government. Sometimes they work for the banks before the government, or after, or both. Jamie Dimon says regulation stoked banking turmoil. We got used to a certain set of market conditions and thought they wouldn't change, then they did. Pretty common piece of hindsight of every large business failure. Flawed stress test. Not a word on this until now. He makes himself sound like some sort of all-knowing saint when he is as scummy as the rest of them. Where were his insights before, during, and after the stress tests were done? They could have ran their own stress tests if they thought the regulatory ones were inadequate, but they didn't because that would cost them money. Don't make a mistake. They have known everything what they have done wrong. It is just a failed attempt at trying to look innocent when they have done all the crap they could have done. It's also important to note that they don't see it as something they did wrong. They see it as a game where they make millions bending the rules until they break, then walk away shrugging and pointing fingers. It's all fully rational when you're insanely greedy and have no problem lying about everything you do. He's correct though. The Dodd-Frank stress test requirements relied on long-dated bonds. Nothing prevented SVB from running whatever stress tests they wanted. We only do risk analysis if the government tells us to. Isn't a very competent leadership. Bank worker here, this has been an ongoing pain point in my industry since the stress test's inception. Just because you're hearing about it for the first time doesn't mean Dimon's being capped in hindsight. The man's a legend and he's speaking truth. The only effective stress test is the the one that allows them to fail. Agree, the stress test should include a large interest rate rise, but the private administration should not have signed off on removing audits from mid-sized banks. Audits weren't removed, the requirement to perform one specific set of tests was dropped. Those tests are still performed at basically every mid-sized and larger bank even without the mandate. The problem with this bank wasn't that specific test, it was different tests they're required to do. One such test is prescribed by 12 CFR. The bank didn't like the model results, so they manipulated assumptions to get the results they wanted. So which particular investment should these banks have bought that would have been safer? Only thing I can think of is shorter duration treasuries. Looks like poor management decision going with long dated treasuries at ultra low rates. They really wanted that extra fraction of a percent in their spread. Short-term treasuries, repos, commercial paper. These are actually truly safe investments made by money market funds, unlike long-term treasuries which are exposed to interest rate risk. Interest rate swaps to protect against a rapid rise in rates, inflation-protected bonds like TIPS, floating rate debt to counterbalance their floating rate liabilities, and startup deposits that were also subject to interest rate risk. Literally nothing. 0% return is better than a loss. You can always count on this guy to come up with an absurd and disingenuous take on everything. Who do you think designed the regulations and stress tests that are in place? And lobby to have these rather than reenact Glass-Steagall and break up banks that are too big to bail? I too ask to remove the rules I don't follow. If you need government to listen to your wishes, then you really need to be a banker first, then you will be able to make your demands. If you are not a banker, then these people are not going to even listen to you. How about banks take responsibility for the risk they take and not rely on taxpayer money to bail them out? How about separating investment banks from regular savings banks? How about forcing banks to break up if they get too big? It was definitely regulators who forced those banks to buy all those long-term treasury bonds when the dumbest kid in their first year of finance could have told you rates would rise. Let's be real. These banks took on irresponsible amounts of risks that resulted in collapse. They built their own house of cards, and they did so largely knowing that they would be bailed out if they messed it up, likely causing them to care even less about their actions. It's people like Jamie Dimon who cause these crises. The regulators are at fault only for being too lenient, and the government too ready to take big money in order to water down the regulations. Dimon is being silly. Yes, it's true treasuries would be considered safer, no counterparty or default risk. The only risks are inflation and, well, inflation. But, and this is a very big but, everyone knows the further out you go in time, the riskier it gets. Everyone knows this. It's bond investing 101. I was really surprised that banks had gone out and bought long-term treasuries. Really surprised. That's not something that was done in any way that would be remotely dangerous back when I was working for the banks, which admittedly was a while ago. In other words, yes, for regulatory purposes, treasuries are fine, but to think you could buy a long-term treasuries and be safe when rates went up, you'd have to be a complete fool. Regarding stress tests, he's just annoyed he has to employ and actually listen to his risk managers. Yes, I was there for that, he can go pound sand. A bunch of sarcastic replies in here and nothing of substance of what he actually said. This makes complete sense. Stress tests should incorporate likely stresses that should actually measure resiliency of how banks would function. High interest rates almost certainly should be one of them. If what he's saying is true and they weren't, that's a massive mess up. That makes sense, but there is no way that these people did not see it coming. It was obvious that it is going to happen, and even the normal people saw it coming, so saying that they did not see it coming is complete crap. Was it obvious in early and mid-2021 when SVB locked in sub 2% interest rates on the 10-year treasury? If it was obvious, why were market rates on the 10-year treasury sub 2%? Look, it's clearly a poor business that didn't understand how to hedge and manage its risk, and they paid the price for it. But at least part of the blame has to go on Peter Thiel and Silicon Valley, herd animals who create a bank run just because they can. Even worse, the stress testing based on the scenario devised by the Federal Reserve Board never incorporated interest rates at higher levels. He's not wrong, and go back to early 2022 and the Fed dot plot was showing a peak of 2.5 to 3%. Every signal the banks got from government was that this wasn't a risk. SIVB would still be here today if that were true. No excuse, I come into work every day and I have a very specific job. You're going to tell me the bank the size of SVB didn't have an entire department devoted to this sort of forecasting and risk assessment. Of course they did. What likely happened is any warnings went up the chain of command where they were probably cast aside. This is kind of why whining by Diamond is just sour grapes by bankers, because they know it means more regulation and less money. We already know the risk committee at SVB did see how fast they could blow up against higher interest rates. The problem was SVB wanted higher growth targets, and the CFO, not a typo, ordered the risk committee to fudge. This wasn't an accident, this was a crime. SVB had too much in deposits for its equity base. It could have slashed interest rates and driven deposits to other institutions while earning good profits. It could have shared risk with larger banks. It could have done an equity offering. It instead decided to gamble and lost. That's kind of my point. These things didn't come out of nowhere. The rate hikes happened well over 1 year. It wasn't like the bank came in on a random Monday and rates were 5%. Deliberate decisions were made and now the bankers are worried about the excess regulation. Well, maybe if they didn't need to get bailed out all the time, we wouldn't need extra rules. I mean, he's not wrong. He and many others pointed this out prior to the recent banking issues. He's not suggesting that there should be no regulation, just that the existing regulations absolutely incentivized buying treasuries when interest was crazy low, and also criticizing regulators for using a flawed stress test system based on eternally low interest rates, ironically carried out by the same institution that raised rates rapidly. All factual. A competent bank wouldn't have sunk so much money into long-term debt when rates couldn't possibly have gone any lower. Idiotic choices by SVB aren't the fault of the federal government.